Premier has posted a 26.8% rise in full-year headline earnings per share. That's despite the food and consumer goods group facing tough economic conditions and volatile commodity prices. The company says it achieved growth across its key divisions thanks to a firm grip on costs and improved efficiencies. The owner of brands such as Snowflake Flour has declared a final dividend of R2.71 per share. That's up 23% on the previous payout. Premier expects lower maize prices and subdued wheat costs to support affordability and moderate revenue growth into the new financial year. And joining us for a closer look at the performance is company CEO Kobus Gertenbach. Kobus, thanks so much for your time this afternoon. So revenue up 7%, while HEPS is up double digits, over 26%. Just characterize the year that was for the company and some of the factors that have capped further growth in revenue.
Thank you very much for the opportunity. Our business is very heavily dependent on soft commodity prices, in particular the price of maize and the price of wheat. And I think if you look at the maize category as a whole, it was a very difficult year for maize. We had a big Southern African drought last year, and South Africa ended up being the breadbasket that really had to assist in feeding a lot of our neighboring countries, and that created an overall shortage of maize that pushed up the price quite substantially. So we had to cope with that, and I think the overall category had quite big volume declines as a result of those very high prices that were especially prevalent in the market since November. But the exact opposite happened in the wheat category, where global wheat supplies have been good and global wheat prices have been fairly flat. And so if you look at inflation across our bread and flour categories, where you've mentioned Snowflake, we've pretty much been close to zero inflation for most of the last 2 years. And so that ultimately had a big impact on us not growing our revenue faster. But you also go and have a look, in the first 6 months, we did just under 4% revenue growth. And so to get to an average number for the year of just under 7%, we actually grew the second 6 months around about 10% at the revenue line. And so the trend really is for us for the revenue to start picking up again from a growth perspective.
And sticking with those soft commodity prices, Kobus, and how that also influences your pricing power. I know in the interim period, the group didn't pass on prices to consumers. Was that still the case in the second half of the year?
Yeah, I mean, our price changes on the whole, as I say, the whole wheat supply chain from cake flour all the way through to bread. The price changes have been negligent. I mean, it's really hasn't been any at all. Where we've had to push through the big price increases was on the maize side, where the raw materials just ran through the roof, and we had no alternative but to put up the prices of super maize meal. But I guess the more important point is that maize meal has come down substantially in terms of pricing. If you look at what the consumer paid in November last year versus what they pay now in May, you almost have 9 billion rand of disposable income available to the consumers just in lower super maize meal prices at the moment. And so we're through the wave, we're through the worst of it, and the new season harvest is coming off, and the consumers really gotten the benefit of that relief.
All right. Talk to me about cost containment measures. The group points to a tight lid on expenses as one of the factors that has boosted growth. Is this also why we've seen an expansion in margins?
Yes, very much so. I mean, we've continued to invest quite significant amounts of capital to improve our facilities, improve our economies of scale, remove bottlenecks, drive bigger throughput in our factories and our bakeries, and make our distribution infrastructure and our sales infrastructure more efficient. And I think that the investments that we've made in systems, processes, capital equipment across the board really has continued to allow us just to drive big efficiencies and make sure that that we improve our economies of scale the whole time.
And just talking about investments in the company, the group is takes rather investing in facilities and operational efficiencies quite seriously. And I know when we had the hectic bout of load shedding, that was also something the group spared capex on. Are you seeing the same thing playing out when it comes to the water shortages?
Look, we've been at risk from a water supply perspective, I think, in various areas for over a decade. I mean, our biggest maize mill sits in Kroonstad, and I mean, Kroonstad 10 years ago already didn't have any potable water in the municipal water infrastructure. And so we've made the investments over the years. We've sunk boreholes, we've put storage tanks up, and we've put purification facilities in. And, in certain areas, we've even done that for the communities themselves, where we've also supplied water infrastructure through boreholes and tanks and pumps and solar and everything else. And so we've been very active in this space for a long time. And so we actually have been quite prepared and really, in most instances, have insulated ourselves from that risk with the investments we've made over the last 10 years already.
Mm-hmm. All right, and sticking with CapEx, what other growth areas are you seeing? Where will you be putting money into the next financial year?
Well, we're busy with a 700 million rand project to upgrade the bakery in the south of Johannesburg in Aeroton, and it's a bakery that will service a very large part of the southern parts of Gauteng, East Rand, West Rand, South Rand, all the way into the Free State and Northwest Province. And so it's been a multi-year project for us, and we're very excited that bakery is finally should start up in the second half of our financial year, so somewhere just before Christmas. We're hoping to have that up and running. And I think that the capability that we have there, the efficiencies that we'll gain from consolidating smaller subscale bakeries into that large-scale bakery and have brand new state-of-the-art equipment will also enable us to not drive efficiency, but also put a consistent, extremely top-quality product on the shelf that consumers in the rest of the country has recognized and have been very prepared to buy. So I think that we're excited about that. It should come on stream, and it should really create an opportunity for us to also, in this part of the market, get up to the market share that we already have in the rest of the country.
You touch on consolidating those smaller bakeries. Kobus, are you looking at acquisitions in the near future, considering that, the balance sheet is quite healthy and you've been making progress with reducing debt?
Yes, I think that we've been very actively and constructively engaging on all opportunities. There's private businesses that come up for sale all the time, and so we're constantly looking at opportunities there. We're very disciplined. We know what we think will fit with our business to create value. We know what the financial metrics are that we need to meet in order to create value for our shareholders. And so, we're not just on a drive to build a bigger kingdom. We have to ultimately continue to make ourselves stronger and better. And if you in this environment are not able to be the lowest cost producer in the categories that you operate in, then longer term, you're not going to be able to sustain the business. And so to the extent that opportunities allows us to do that, leverage our existing cost structures, our existing delivery platforms, logistics, operations, we certainly will go ahead and add those businesses on if we can find a way to agree a reasonable prices with the sellers of those opportunities.
All right, and before I let you go, how have you been managing risks playing out in Mozambique? That market hit by civil unrest, I can imagine that has affected operations there.
Oh, very much so. I mean, I think that in the first place, we have an incredible management team in that country with really highly skilled and highly motivated workforce as well. And the extent to which our employees there and our people in Mozambique managed to isolate and insulate our facilities from not getting damaged during the political unrest was actually an incredible effort that it took. And then once the worst of the political unrest subsided in the middle of January, we actually suddenly started trading extremely well because the supply chains were empty and people were in need of the basic staple foods that we provide. And I think that since then we've been highly encouraged by strong trading in that facility in spite of the difficult economic times. Currency availability remains a major concern, and it has at times hampered our operation because we have to import wheat and maize into Mozambique. It's not produced locally to sort of manufacture the products that we supply there. And we really feel at the moment it looks like the supply is okay, and the banks and everybody in the financial world, I think, recognizes that they need to make currency available to basic food providers first before a lot of other entities get access to currency. And I would hope that arrangements and efforts that we've put in place will allow us to continue to sustain that business and actually see a bit of a recovery in the performance of it.
All right, Kobus, thanks so much for your time and taking us through the year that was for Premier. That was Kobus Gertenbach, CEO of Premier Group.